Hello, I want to welcome everyone participating in today's webinar, Building an Indirect Rate for Nonprofits with Federal Awards. This is part 3 of our webinar series, the Indirect Rate Toolkit for Nonprofits with Federal Grants. My name is Yevgeny Sahenko, and I am a controller for outsourced accounting and advisory services at GRF CPAs Advisors, formerly known as Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you'll need to do to earn CPE credit. All participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following our webinar. You will be asked to recall these words in order to receive the CPE credit. Please write the CPE words down when they're given and keep them until you receive your certificate, as they will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. Additionally, the slide deck and the recording from today's webinar will be made available for download after the webinar has been completed. You will also receive a follow-up email with direct links. Any technical support and CPE questions may be addressed to Nathan McLeveen at mcelven@grfcpa.com. And today's learning objective is to provide practical guidance for building an indirect rate for nonprofits with federal awards. And with that, I'd like to introduce your presenters for today's webinar. Paul Calabrese is a principal in the firm's outsourced accounting and advisory services group. Mr. Calabrese brings a successful track record of working with both nonprofits and government contractors. His remarkable career includes positions with the Air Force Audit Agency, DCAA, and 3 government contractors, in addition to 20+ years in public accounting. Tricia Catabini is a senior manager in the firm's audit department. Ms. Catabini has worked in public accounting for more than 12 years, specializing in serving the nonprofit sector. And with that, I'll turn the presentation over to Paul.
Hello, everyone. Well, let's go to the next slide, and we'll begin with just discussing a little bit about direct cost and indirect cost, and first focusing on direct cost because there's a relationship in the indirect rate model. So direct costs are costs that we can identify to an activity, a program. We're talking and often relate to federal awards and federal grants or subawards. So these are items that can be identified to a particular federal award or subaward pass-through. And we know that there are elements of cost, direct labor, the applied fringe on direct labor, that part's actually considered direct. Direct material supplies, consultants, subawards, travel, all of that, even equipment is often can be purchased direct with certain restrictions and approvals. In prior sessions, we talked about direct charging of salaries of administrative personnel, and generally a lot of people were doing this in the past, and now we have a regulatory permission to do it. If you have an executive director and it's a very small entity and they are the rainmaker and also one of the technical people, it's not uncommon to see in a small nonprofit or some other type of recipient of federal money where that top level person is charging direct. And as well, that could be some finance people filling in as a grants administrator function, you know, doing draws for the federal awards or invoices if they're a sub, and a variety of other duties which are very important, like keeping track of budget versus actual. It just means that their time must be charged direct through some mechanism, generally a time report or some form of timekeeping. And then if it's 5% direct, then obviously for their time, the rest is 95% indirect, if it were that simple kind of model. There's also direct proration of cost between 2 or more activities that are common. This is not necessarily the direct allocation method. This is just simply you have costs and it relates to 2 different activities, 2 different programs, 2 different federal awards, and you've got an allocable and simple way to allocate between the two. And then there's the concept that unallowable direct costs remain in the base. In a simplified model or thinking, some people feel if it's quote unquote billable, or we can draw or submit an invoice to the government, it's direct. And if we can't, then it's somehow indirect. And that's not the correct definition. The direct definition of direct costs is direct costs that are identified to a cost objective or to a program or activity, whether or not they can be recovered. So that's something, and those types of costs would be for sure public relations, membership, fundraising, lobbying activities. Always they will be treated as direct. Next slide. So indirect rates, the funny thing about indirect rates is that they're called a lot of different names, and they can be also very nasty names, but they're burdens, loading, overhead. In the nonprofit world particularly, they're often called fringe or G&A or M&G for management in general, G&A for general administrative. But the federal government on uniform guidance decided to take a definition, I believe, that was used by institutions of higher education. That's facility and administrative rate. So they're referred to as F&A rates. And forgive me if for sometimes you see it referred in our other slides as G&A or M&G. We're really referring to F&A.
Thanks, Paul. And before we move any further, we're going to go over our first polling question. And our question is, which of the following expense items are generally considered indirect and require an indirect rate for allocating these items? Is it A, office supplies, B, telephone, C, postage, D, periodicals, or E, all of the above? With that, please take a moment to answer. While everybody is submitting their answers, I'll provide the first CPE word. Our first CPE word is base. If you want to receive CPE credit, please remember that you have to jot these words down because you'll need them for the survey following our webinar. Again, the first CPE word is base, B-A-S-E.
There you go. So people, did very, very well here because it is all the above. But if you had mentioned the others, for sure, they're also a part of it. But the answer is all the above. So indirect costs are costs, as you just saw, the pens and the pencils, the envelopes, the erasers, all the paper clips, as we think of those items, but also personnel and other costs, even audit fees, generally indirect, that need to be apportioned to some direct program activity or project activity. And it's not economically feasible to do it any other way. To be honest with you, and I know some people may scratch their head after I say this, indirect rates are to make things simple. It's to simplify, it's a simple fraction numerator over denominator. Now, some of you are very advanced people, and we got intermediate, and then we got some people new to this. So some of this stuff, I apologize to some people who want more challenge, that this may sound very basic, but we have to cover it for all people that are just entering here. So we appreciate your patience. In developing a cost pool, it talks about making sure that we don't double charge. So direct purpose costs remain direct, indirect purpose costs go indirect. There's little exceptions to that, but I'm not going to go over it to confuse you. So you can have direct travel for a direct purpose on an award, let's say a federal award for NSF, National Science Foundation, but you can also have the administrative personnel and executive director for other purposes not relating to the NSF award, but just simply that person is traveling to some symposium or some else that's of an indirect nature and thus charged indirect. And the last, it shows you some of the typical expenses for which I pull the polling question. Next slide. So let's give an example. If we're going to deal with indirect rates, Fringe Pool is a very simple simple kind of way of expressing a numerator over denominator. In this very simple pool, I'm simplifying things and it's done academically. So we're only going to have pension, like a 403B plan, medical insurance, payroll taxes. There would obviously be much, much more. And it's only going to apply direct personnel. I didn't put any indirect personnel working on multiple programs that cannot be economically assigned. So each of those three expenses reside in what we call a cost pool. So pools, as you can imagine, you think of a pool table, a swimming pool. There are many different words for the word pool, and I suppose it's an old-fashioned term. But pooling meaning putting costs together to a final cost objective or grant. And so fringe expenses become like the numerator, and total labor dollars become the denominator. For most nonprofits, they include their paid absence in the wage line. So for that reason, the numerator doesn't have paid absence, and that's just generally the way it works. What we find is that the fringe cost pool, those items are like a dependent variable, and the denominator, the fringe allocation base, productive or total labor, including paid absence, is the independent variable. So as probably what happens as your revenues go up, because nonprofits and other recipients don't often develop widgets unless they're doing some kind of R&D effort. And so as the labor goes up and as you get more work, the labor goes up, and guess what? Your fringe benefits correlate and go up as well, or go down if you lose work. And so when we think of it and we want to set up a simple kind of, on the left side, a numerator, and then we see some things on the right side to apply it. A fringe pool would have 1,500 pension, 1,500 medical insurance as an example, and 500 payroll tax. For a numerator of 3,500, and it's applied on the right because the total denominator is 10,000 in this example. Again, not including indirect, which could be in and should be in here, but I just wanted to make it simple. And there's two grants, A and B. Grant A has $2,000 direct labor, grant B has $8,000. And so 2,000 times 35%, we'll see on the next slide as we apply the rate. 2,000 times 35% is 700. That's your fringe. And 35% times 8,000 is 2,800. If you add 2,800 and 700, you get back to your 3,500. And then there are other direct costs if you want to do the total cost there. So like 1,400 to 2,700 is 4,100 as an example. What about your, oops, we went one slide too far. What about your general fund? I've heard it called a lot of different things, administrative costs. What do you do with those expenses? You have an executive director's office, finance, HRIT, purchasing, facility management. You have all kinds of support labor. You have office space is a large line item, utilities, your audits, your insurance, and so many more. In this make-believe example, we just said the indirect pool has 150,000 A, and the programs, the allocation base has 1 million, for which there's 900,000 of non-federal fundraising, PR promotion, and 100,000 federal award. And so you got $1 million, and obviously 150,000 over 1 million is 15%. So the next slide shows us what we do with that, or conceptually. The base was 1 million. 900,000 is the green. The yellow federal award is 100,000, which is only 10% of the base. We had a 15% rate, so 15% times the yellow piece of 100,000 equals 15,000. So you can kind of conceptually see the piece of the pie. And the other part of G&A, or excuse me, F&A, that's not going to a federal award, the 90%, that's 135,000. So 135,000 and 15,000, again, total your 150,000 numerator. And we can see the math here, 100,000 direct cost times 15% equals to get, well, equals 15,000, and then the two together is 115,000. There is a total cost definition from the uniform guidance. That's the sum of direct and indirect allocable costs, less credits, refunds, rebates, and excluding unallowable expenses or costs. So as you can see, this is kind of like, yes, there are different ways to build indirect rates, and there are unique parts of that, as we've discussed before and shown you some different types of rates. But the two most common is a fringe benefit rate and some kind of general administrative, we'll call it F&A for this purpose. You can see that by multiplying a fringe rate of 1.35 times a G&A, if it were 25%, gives you this factor 1.6875. And what that says, if you round it, is that for every dollar direct labor dollar spent, you need 69 cents of apportioned fringe benefit costs to keep your people there that you've decided, and your various administrative support costs. Auditors are quite familiar when they come in every year, no matter what they do, they will be doing kind of like a flex analysis, especially with expense costs. And what they're looking at is like 18 and 19. There was no change in pension and payroll, but there was a change in uptick in medical. And that's one way to look at it. But when you take these expenses and make them a percent of the denominator, like in 19, 1,500 is 20% of 7,500, but it's 15% of 10,018. And so what you begin to do is, if you had a lot of expense accounts, you can sit down there and say anything greater than 5% or 10% or whatever your concern is, I'm going to analyze and spend a little bit more time. But the other secret thing and message here is that the denominator affects your rate. If your rate was 3,500 over 10,000, you're 35%. The minute you increase by 1,000, the rate doesn't go up so much, but when you decrease the denominator by 2,500, now the rate really jumps. So when you look at indirect rates and you're comparing, the best way to compare is yourself, your own organization from year to year. It's going to be hard to compare with others as a clue of something coming up. But what I would share with you is that when there's a drop in your base, your rates are gonna go up, and that tells you a lot about the organization and where you're going.
Thanks, Paul. And we've now come to our second polling question. And our second polling question is, an ideal indirect rate is the highest rate percentage that you can obtain for full cost recovery. Is that statement true, or is it false? And please take a moment to answer. While everybody is recording their answers, I'll provide the second CPE word. Our second CPE word is allocate. Remember, if you want to receive CPE credit, you'll need to jot these words down because you'll need them for our survey following the webinar. Again, our second CPE word is allocate. A-L-L-O-C-A-T-E.
Wow. Well, the answer is false. So I'm sure a lot of you are going to scratch your head. Let's go to the next slide and let's talk about it. Indirect rates, as I stated before, is a function of a denominator. So depending upon how large or small the denominator is how it's going to affect your rate. So some ways, a lower rate is optimum if that's the true cost over a larger allocation base. I think most of us know the simple math. If you have 100 and it's over 500, that's 20%. If you have 100 over 1,000, that's 10%. So 10 or 20% isn't really the answer. You still have 100 to start with. You had 100 over 1,000 and 100 over 500. So if everything worked out well and you were 100% with federal awards that were cost reimbursable, you still get the $100. It's just that one rate says because the base is small, or maybe because you took out sub-awards, It's now down to 500, and so it makes your rate go up, but it's still the same. Still the same cost recovery. You're not going to get more than your G&A pool, excuse me, F&A pool of 100 in either example. And in this, why I showed the clouds and everything is just that. It's what is the ideal rate is almost like what is the meaning of life to some degree. And there are a lot of different answers. Many of you said the higher the rate, the better for cost recovery, but actually it may not be. And let me show you this simple example. Say you had work with the Robert Woods Foundation, which is, I believe, a real foundation. And I think often they used to use a 9% ceiling. Now they may have a 12% cap. Well, if you have a 15% rate, you're going to lose 3%. If you have a 40% rate, you're going to lose a lot more. But you'll say, but Paul, it was based on salaries and wages and not on a total cost base or total modified total direct cost base. And I agree with you, but will they understand that? Will they look at everything, your funders, and just see you and adjust to you? And then if they have a 12% rate, how are they going to adjust it if it's on a total cost base, if that's the way they do it versus a salaries and wages base? So you see a lot of these issues come into play if you have a lot of foundations and you deal, or local governments who will put caps on indirect rates. Whereas maybe in the federal, you don't see it as much unless you're on Ryan White, payer of last resort, where they have a 10% cap for direct or indirect. And administrative costs, I won't get more into detail than that. Or CSEP, Department of Labor. I think they had, in past, I've seen 13% caps, but they may not today, but I've seen them in the past. So, okay. So if you're going to develop a G&A, F&A rate, what are some of the concepts? And it's stuff that's just not, the government's going to say do this or do that, but they don't give you all the details, which is not always fair, but they feel, that some of this you have to learn yourself. And the first thing is that generally it's over your cost accounting period is your fiscal year, 12-month period, can only be a rate for one entity. So if you got a grant and in a 501c3, and then you also have a, maybe a 501c6 or a 501c foundation, I'm not sure on all the regs, maybe Tricia can help me with that, but you can only have one entity have one indirect rate. If two entities that are related have rates, then you're going to have two rates. And it must benefit the organization as a whole. If the indirect rate does not, there is something called special rates, but you'll have to get special approval for that. Okay. A lot of rates that we negotiate with the government, or the most common, it's what we call a final rate, and it's based on the prior year, and it's the final historical cost. And so the final indirect cost for a prior year, then obviously last year's fiscal information is going to be the most important based on a post-audit trial balance and all that if it's been audited. But you may also do a predetermined rate, which is an estimate of the current or future year rates. And therefore your year-to-date trial balance would be important. And then you'd have to get the rest of the data if you're like 5 months through your years. Because if we're sitting in June and you're on a calendar year basis, you would only have 5 months to date. You'd have to, if you want to develop a full year rate, you'd have to get 7 months, the last 7 months of the year from your budget, your annual budget. And some people, they don't break their budget down. It's just a total year budget. If you do an annual budget, I highly encourage you to do it by month. A lot for these types of special reasons. How are your current chart of accounts set up? And you would want to use, if you're developing rates, the most current audited financials. I would look often at the statement of functional expense because it gives you a lot of good detail. I would also look at the annual budget when I'm developing an indirect rate because I want to see what that is. In other words, I might want to look at the budget for the current year and develop a rate, which may not be too difficult to develop, and as well, a rate for the prior year and kind of see where they're at. Grant documents are very useful because if you've never developed an indirect rate and you're just using de minimis rates. So if you're going to develop a rate, we're talking about what they often call a negotiated indirect cost rate agreement, or NICRA, N-I-C-R-A, NICRA. So in using this information, again, the last 12 months are very important from post-audit trial balance or a hybrid if you're going to do a predetermined estimated rate. And the government does allow estimated rates. In fact, you could have an estimated rate even though you have historical information. It doesn't just have to be because you don't have historical information, but you do have historical information, but the next year is going to be so much different. And so it's often in the labor line that something's going to be different. And there you're just going to have to start providing information to them to assure them that this is truly what's going to happen. And that is a challenge. So the most relevant is the prior year historical, but again, combining it is a possible thing to do a predetermined rate. We're starting to get into the importance of the statement of functional expense. And so we'll be eliciting a lot of Tricia's help, as she is one of our great auditors, and she'll talk to you about some of the regulations, because it's important to have a proper statement of functional expense. There are a lot of forces on the outside that impact it. You know, the IRS has had statement of functional expense for a long time, since their 2008 last major revision in ASC 958, or the old FASB 117. And even the Department of Health and Human Service and Labor, when you start to develop an indirect rate, they basically have you take and modify the statement of functional expense. So obviously it's an important document, and you certainly would be good to have it as part of your audit.
Great, thanks, Paul. And we've now reached our final polling question. And our question is, which of the following statements is true regarding the statement of functional expense? Is it A, fully allocating overhead costs from M&G or management in general to the other program and fundraising activities? B, distributing occupancy, utilities, and depreciation from M&G to other program and fundraising activities? C, depreciation cannot be apportioned unless it is 100% indirect? Or D, I let my public accounting firm prepare my statement of functional expense? Please take a moment to answer. While everybody's submitting their answers, I'll provide our final CPE word. Our final CPE word is fiscal. Remember, if you want to receive CPE credit, you'll need these words for the survey following our webinar. Again, the final CPE word is fiscal, F-I-S-C-A-L.
Okay, so it looks like everyone, or at least half of you, believe that allocating overhead costs from M&G to other activities would be the correct answer. So one of the things that we kind of wanted to clarify as we talk through what the statement of functional expenses really looks like is that fully allocated costs, overhead costs, fully loaded allocations are no longer allowed under the new accounting standards update when it comes to functional expenses. So really, the second one, B, distributing occupancy, utilities, and depreciation from M&G was the correct answer, as long as it's not 100% a direct expense. So moving on as a part of this presentation, a couple of things that I just wanted to highlight that Paul was mentioning is that as an auditor, I obviously work with a lot of organizations, and under the new accounting standards update, a lot of organizations have elected to also include now a statement of functional expense under the new requirement to show their expenses by natural classification as well as functional classification. So in working with that, you're able to clearly see some of those natural line items that we have here as a sample example of a statement of functional expense. Now, one of the things that I just wanted to highlight here is this is an example that we would have given prior to the new accounting standard update that was issued for 2016-14 that really updated the presentation of nonprofit financial statements. So one of the things I wanted to highlight here is at the very bottom, you'll see there's a general and administrative allocation. And as I mentioned when we went over the polling question, that fully loaded allocation is no longer required. So this line, as a new example, would go away. So what this organization previously was doing is that they would have their indirects and they would have them allocated, such things like your occupancy, your utilities, your depreciation, your salaries. But then you also still have, let's say, $2 million left within your management and general bucket. And then what they were doing is they were taking those indirect rates that each of their either foundation grants or their government grants were doing and allocating them once again back into their programs. So that's where this general and administrative allocation line was coming from and being generated from, which basically pulled out almost 100% of all of their general and administrative expenses when you looked at that total line on the very bottom of their statement of functional expense. But again, as I mentioned, that fully allocated cost really is not something that from a technical guidance standpoint, at least the literature that we read and kind of go along with for our firm, is no longer interpreted to be allowed, right? So again, this is not your indirect cost as a part of an audit, meaning that if you have your fundraising team sitting in an office space, obviously you want to allocate some of that occupancy and that depreciation for that space or those assets over back into the programs or into fundraising. That's not what we're talking about here. Again, these are just those recouping of some of those overhead costs from the foundation grants, from their federal grants. And, you know, as Paul was sitting there talking about doing true up for the indirect rates at the end and the conclusion of an audit, he was talking about a post-trial balance, post-audit trial balance, to really look at what your true indirect rate should be for the year from the prior audit. I know a lot of organizations that I work with don't exactly go back and do a true up, and they don't do that for you know, various different reasons, but I always encourage them that if you're looking at it and your predetermined rate or even your provisional rates, whatever you may have, aren't close to what those prior year audited financial statement numbers are, I always encourage them to go back and take a look at them and talk with their grants officer and managers to ensure that they are getting what they can truly recoup. Because again, I've got some organizations who are sitting in a realm of, you know, as Paul mentioned, like 10, 12% for an indirect rate, but really their true indirect rate sits somewhere around 20%, which is a lot of money that they've left on the table. So, you know, working with somebody like Paul who really understands how to go about and get those predetermined rates or get the true ups out there to kind of recoup what those costs are is really beneficial. So again, I mentioned this is just a sample of what perhaps an old statement of functional expense would look like on your, that you have here on your screen. We've got our different programs here. I left off the M&G columns and the fundraising column from this particular one, just simply because it was spanning 2 pages. It would be too much for you all to look at. But a couple of different things have changed here. So if we want to flip to the next slide, as you'll see here, that general and administrative allocation line has since gone away. So this would be the new statement of functional expense that the organization has under the new accounting standard update 2016-14, which changed the presentation. But you'll also see now that there is a less cost of goods sold included with revenues in the statement of activities. And we have a reconciliation now at the very bottom. So one of the things that I always let my organizations know is that all expenses, no matter if they're netted with revenue or not, should be included on your statement of functional expenses going forward. The only exception are investment management fees. So obviously we all know that also changed. Investment management fees are now netted with investment income on the statement of activities up in the revenue section, or perhaps if, depending on what type of organization you are, they might be considered a below the line type of activity, but they are not included in your functional expenses. However, if you have cost of goods sold, that might be netted with revenue. If you have special event expenses, that might be netted with revenue. Or perhaps, let's say, tuition discounts, if you're an organization that has tuition. Those are the kinds of things that you would still report here on the statement of functional expense, even though they're not included in necessarily your functional expense total. And then you would have to show a reconciliation here. The other thing is that the standard does stipulate that bad debt should be considered to be general and administrative here. You will see in the sample in front of you, however, that this organization has it going into programs, mainly because they are ones that deal specifically with patient clinics. So, you know, we've been able to at least work with them and understand that, you know, patient clinics and those fees really are revenue to the program, and then writing off those medical service fees. Well, obviously that should be directly attributable to that program. So that's just kind of the picking apart of different things that we would see in that statement of functional expense, and why it's really important to have something that is allocated appropriately. And then Paul can kind of get into a little bit more here over the different feedbacks on what to do with your functional expenses and your indirect rate.
Awesome. Yeah, the only other thing I would add is what you said is if something, Tricia, is netted, like you said, investment management fees up in the top against revenue on the statement of activities, those expenses at this point, though not shown, like you said, in the statement of functional expense, we still got to add them in to the total picture, so that, in other words, fundraising that's unallowable expenses have to be added to the base. Does that make sense, Tricia?
It does.
Okay. So there's sometimes, so what we're going to have to do is go hunt for expenses now. Just kidding there, but we have to look at everything because an indirect rate submission has to cover all of it. But the statement of functional expense has an awful lot. It's a great presentation. To me, it provides a great analysis for you to analyze what is really going on with your organization. So in terms of your annual budget, the only reason why I keep focusing back to the annual budget is because if it's set up in some way, or can be set up as one of the documents, not just a statement of activities, but a statement of functional expense, you're begin to start to analyze things. And ultimately, because we use the statement of functional expense in all of the rate submission documents, that's what they want to see. You just basically modify it, removing unallowables, adding or subtracting to the base, those kinds of things to come up with your indirect rate. And so if your budget begins to do that, it gives you an idea of not only looking back, but looking forward into what your rate should be, because we should not just do these things because we're told to do these things. We also should be doing them to analyze exactly where are our rates going. So we have like a target rate for this year, even though we'll look back to last year's historical year as well. Okay. One of the last things we kind of jumped over a little too quickly is, as you may or may not know, there can be like a break in service. And so the new rules that may come into being says if you have a NICRA, a negotiated rate in the past, you have a break in service, currently you cannot use the de minimis rate if you think it's simpler. The new rule may allow a break in service and allow you to go back to a de minimis rate. But in any event, what if you came to an organization and you did hear that they had federal awards in the past, but like sometimes they move into foundation awards, they move into something else, or fee for service, and then it's like a big circle. They come back to the government depending upon what the requirements are and so forth. And in that event, I would like to ask people, you know, if I was a new CFO or a finance director, have we had a rate in the past? Yeah, we did. Could I look at that NICRA negotiated indirect cost rate agreement, because there might be an awful lot of information in there that could be helpful to me. And with some of the things would be, how was the rate set up? What kind of allocation base did you use? Was it salaries and wages? Was it a modified, total direct cost base? Which years did it apply? And so forth. Obviously, it's long ago and it would be out of date, but often with a negotiated rate, what is your past rate, which is your final rate, often becomes the provisional rate going forward. So good information. A framework for developing your cost accounting system and negotiating rates is what I call cost accounting matrix. A matrix is just rows and columns. And usually the columns are like either at a larger scale, the functional areas, and at a greater detail area, it could be various programs, could be federal, non-federal, and all of the kinds of activities. And the rows obviously would be your natural or your expense accounts. And you can see that a structured system makes a lot of sense because it can facilitate project costing, but of course it must break down grants, federal awards, non-federal, federal from each other because they're separately funded. And when you're dealing with any funded vehicle, whether it be a federal, state, or local, you must track them separately and uniquely, or a subaward that's been passed to you. All those things must, as well as knowing what is direct and what is indirect. And I structure that as well as segregating unallowable costs. This is one structure here. You can see salaries and fringe. Notice they put in subawards because under 25,000 and over 25,000. If you actually and literally set up expense accounts, and I was delighted to see one organization did that. What that does, it makes it very simple for them because they already know, okay, I don't have to worry. This is already over 25,000, so I'm not going to include it in the base. And it's just everything in that expense account. And it's a tighter, cleaner reconciliation. Okay, next slide. This is a simple format that you would see, like especially on a QuickBooks, where 4,000 is revenue, 5,000 is direct cost or cost of goods sold, 6,000 would be fringe benefits, 7,000 could be occupancy, facility, 8,000 general administrative or facility and administration cost, and 9,000 are unallowables. You see, by structuring it this way, it could be a lot simpler and straightforward to develop an indirect rate, if that is what you're doing a lot of. So when you build an indirect rate, these are some things to really, really start to consider. And here we have occupancy costs allocated to programs for GAAP, the old method, the one-liner old method. But anything that's allocated out to a program that's done because, and I would certainly like to hear what Tricia has to say, but costs that have been taken from G&A and applied on your functional expense or your statement of function expense, those expenses, if you're doing a simplified allocation method, a simplified indirect rate where all your administrative costs and all your facility costs are in the one pool, then you can pull those back into it. Not what I'm trying to say is it would be for a rate computation. So you get into the concept that there can be a rate, or a presentation that you must follow for GAAP and follow those rules, but then you may change that statement of function expense to compute an indirect rate because uniform guidance has you move this up here, move that down there. But again, if you have a simplified, not a direct allocation method, but a simplified where everything is in G&A. Direct allocation means what you'll see in a functional expense where you'll see like different items like rent, utilities, or depreciation, and they've been allocated specifically to various programs, fundraising, as well as G&A. That's the direct allocation method, and then that's the way they stay. And your rate is only what you see in your M&G column, so to speak. But if you're doing a simplified rate, you can pull all those back if that's your methodology. So different people have different methods, and you need to be aware of that so that you can compute your rate properly. Be sensitive to consolidations, where what I call the Inc., the main group, and then you have affiliates. And the affiliates, if they have grants, then the affiliate has to have its own indirect rate. If there's only really one and all the awards are federal awards that you're dealing with are under the Inc., the main group, then that's where you'll have your rate computation. And of course, cross-company affiliates, for example, of allocations. Sometimes you'll have this large organization and they've set up a small group to do fundraising through a foundation. So often what's happened is the people at the main area are kind of leased out part of their time to the foundation, but it's always a small group of people plus their fringe costs. So if there's some fringe costs that are basically resident within the Inc., the main group, those costs that have been allocated out to the foundation, those costs are not a part of the fringe rate. They must be reduced. And often there's an equitable way that probably the rates don't change that much by it, because the pro rata relationship on the fringe rate doesn't necessarily is the same for either. So that may be possible, but you still should be aware of it. And there may be other forms and other types of allocations between the two. There may be a management fee that you have to deal with. If you're giving and getting reimbursed for a management fee from the foundation, then that needs to be offset somewhere in your administrative costs.
Yeah, and Paul, I would say, like, specific to that, one of the things that I typically talk with about my organizations is that some of them have multiple grants going on from foundations or from the federal government or state and local government, and they have to be very cognizant of the fact that they do not double dip, right? So one of those things as well, you know, this is obviously a simplified conversation, you know, but being very cognizant of the fact that you do not double dip, especially if you have foundation grants that are specifically covering the salaries of one particular individual.
Yeah, so everything needs to be tracked separately, those funds. Otherwise, like you said, they'll be double dipping. Let's stay on this for a little bit, this slide. Rental income, the gain in sales, any of those kinds of offsets or offsets to your occupancy pool or to your numerator. And as we talked about before, we talked about investment management fees being netted above. And I've seen also where they have a gala one-time event and those expenses have been netted above on the statement of activities. Those types of fundraising costs must be added to your allocation base. Otherwise, your rate would be a little bit higher than what it might be. Whereas you make the base larger, the rate goes down a little bit. But they want to show the full universe of costs. And it's interesting that I did do a special allocation, a specialized rate. HHS is the kind of organization, if you deal with them, they kind of put you in a box. It's their way or the highway, unless you're super large. But DOJ, they saw the advantage of using specialized rates, and they were open to it. So some agencies, you can make the case. Okay. This is a sample of just the summary negotiated indirect cost rate agreement, NICRA, that was done for an organization. Unfortunately, it's no longer in business, and they permitted me to make a copy with whiting out their name. And but you can see down there, this was their first year, was 2011. So in 2011, they were given a provisional rate for that particular year, and then until amended. And you'll notice that the base is direct salaries and wages, including all fringe benefits. So it's a salaries and fringe base. It's not a total cost, modified total cost rate. And the rate happened to be 15.84. That's what it looks like on the summary page. That's what you're looking for. Okay, let's go to the next one. And then go to the next slide. So the last series of slides for you before we get into our question and answer period is HHS, which is the most popular. These are the hyperlinks. Unfortunately, you'll have to kind of like, you know, cut and paste them, and then they'll have their link, their underlined link. But that's where you go. So if like the fourth one down, this one here, this one actually gives you the sample proposal because I'm quite familiar with it. CNCS is one that I've dealt with. It's the Corporation for National Community Service, something like that. And they use HHS. So does HUD. HUD will use HHS too. So some agencies, they don't have all the capabilities and they just have agreements to work with other agencies. Okay. DOJ has its own group that does it, and they call it the financial guide, is part of their total book on understanding everything that's compliance with allowable direct and indirect and so forth. And they also have a document that you can find which tells you how to prepare. It's very similar to NSF and similar to Department of Labor below. So Department of Labor and its schedules, as well as DOJ, NSF, and I believe also Department of Interior, they have the most schedules. They require the most. The HHS actually for nonprofits requires the least. Okay, let's go to the next one. Department of Education used to have their own little group that would do that, to my knowledge. Now it may go to either labor or HHS. They may, some places may just say, you know, we give you a choice and just go to either one and they'll accept us if we have, because you might say, well, how do I know which agency to send it to? And it's simple, and it's usually based, your cognizant agency to develop indirect rate is based on the most dollars from your SEFA, your schedule of expenditure of federal awards from it. If you're large enough, if you're smaller than 750,000, you'll just have to tally it up, and wherever the largest is. National Science Foundation, you can see below, and Department of Interior. National Science Foundation does everything in policies and procedures with super long names. That's just the way they operate. So that's them. Department of Interior, let's see if there's one more slide. Where does that get us to? Just that is the one where you can get the information for how to prepare an indirect rate. I will turn it over to Yev. Well,
oh, I'm sorry.
Okay.
Yeah. Can you hear me?
Yep.
Okay. Yep. So before we wrap up, and thank you both to Paul and Tricia, we want to take some questions from our online participants and anybody else from the room. And our first question is, typically, how long does it take for a consultant to prepare a NICR submission versus preparing it in-house?
It takes, on average, just an average, could take up to 40 hours. Now, if everything is aligned properly, it can take less time. One of the first things we do is we do reconcile, as Tricia talked about and touched on. We reconcile to your post-audit trial balance or your whatever you provide for us. If it's not a post-audit trial balance, what happens is then we have problems reconciling back to the audit. And then someone would have to get into audit entries. You might say, why? Because let's just use HHS as an example. They want to make sure, and all the other agencies want to make sure it reconciles. If they ask for a statement of functional expense 4 times in their submission documents and you don't provide it or don't have it, you're going to have to develop one, because they won't entertain a rate submission, and they want to see it in that level of detail so they can begin to kind of tear apart and challenge or look at your rate computation. So if everything is smooth and everything goes well and you're small, it may not take that long. However, if you're super large, it could take more than 40 hours. It just depends upon how many internal allocations and how to undo it. There's some that I've dealt with as large as 240 million. Another one was like 125 million. The 125 million was the most complicated because they had a lot of different facilities in New York City. They were doing a lot of different things, and it was just super complicated to kind of break out things and figure out where everything goes. And every year, unfortunately, they changed a little bit of their structure, a little bit of their numbering system, which would pray to you, and I'm sure most CFOs would probably beg you, don't change the numbering systems. Try to keep the grant numbering systems the same from year to year, else you're going to really have a problem tracking. But, you know, you're talking, again, a generic one where things work out and everything reconciles, probably less than 40 hours, maybe less. And of course, it's kind of like, do you yourself understand how to put together submission? Let me share it to you this way. One time I got on one of those websites to invest, you know, do your own investing, and I put in like $1,000, whatever that website was, and it just sat there for about 6 months. Because every time I got on there, I said, I don't know how to invest. I don't know what to trust. I don't know what to do. I'm not saying that's true for you. And some people, that's what they do with an indirect rate. They just look at it and they say, this is not what I do. Or it is what I do, but I just don't have the time, and so I need consultants sometimes. But we have done things with people where we do, and usually do 100% of it, but we've also done it where it's just shared, where we just help a person as they go along, an entity, and we give them advice as they go along. So we're willing to help in any way we can. It just means if you do it yourself, A, will you have an outside person to review it to make sure it's correct? And B, it's going to be a major drain. And the only reason you're doing it yourself is because your funds probably are kind of tight, which is really tough for that. But anyway, those are some of my thoughts on that. I don't know, Tricia, do you have some thoughts?
I think you said it all very well.
Okay. How about the next questions?
Yep, thanks, Paul. So another question for you, Paul. Who did you say was the USG agency that caps their overhead rate at 10%? Found that kind of interesting.
The USG one, that's HRSA, and it's programmatic developed. It's in the actual program, HRSA being for Ryan White, and they call themselves proudly the payer of last resort, and it's 10%, whether it's either direct or indirect administrative costs. I know I've seen CSEP being capped, but I've heard lately that it may not have a cap. So I don't want to say something for sure, but I've seen some DOL requirements where there's some caps on it. Also, Department of Education has some specialized grants that have caps on. They're out there. So just if you're aware of it, it may impact you to think, you know what, I'm just going to go with the de minimis rate.
Okay, got it. And one final question. So is a statement of functional expense required by all organizations?
I think I can take that one. So just as a point of a clarification on the new accounting standard update, organizations are required to report in one place their expenses, both on an actual classification as well as their functional classifications. So when we talk about that, a lot of organizations just say, well, putting it in a statement of functional expense via a matrix is the easiest route, right? It's just now becoming a part of their basic statements. But some organizations I have seen elect to do this in their footnotes. So as long as you have it in one place that is readily accessible and readable for the users of the financial statements, it's permitted to put it on the face of the statement, in a separate statement, or in the footnote.
Okay, got it. Thanks for clarifying that. And just a reminder to everyone, if you have any additional questions after today's program, please reach out to us. Our contact information is on this slide. And so with that, we'd like to thank everyone for attending today's webinar. We encourage you all to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts. And please, again, remember to complete the survey that will follow our webinar if you'd like to receive CPE credit for attending. And thank you all once again for attending, and have a great day.